In today's rundown, we are talking about the continuously unfolding story of GameStop.
Then we're talking about two other stories from the weekend in Myanmar and China.
It is Monday, February 1st. This is the Piper Rundown. We analyze business and culture to help you win. Today's rundown is presented by JetStore. JetStore has been providing affordable, reliable, and easy to manage data storage and cloud solutions to over 4,000 customers worldwide for over 26 years. JetStore offers storage systems for private cloud hosting, video surveillance, Internet of Things, AI, machine learning, edge computing, data archiving, HPC, media production, medical imaging, and flight simulations. For more details, visit jetstore.com. Thank you for sponsoring the rundown.
For one of the first times ever in Rundown history, we are leading two consecutive episodes with the same story, and that is GameStop. The reason we're doing that is because there is much to explore here, and if you do not understand the basics of what's going on there, I'd encourage you to go check out Friday's episode where we talked about the basic mechanics of a short squeeze, who is involved, and the stakes of that.
Yes.
But I am expecting, we're recording this before market open Monday morning. I am expecting this to be a crazy week. I'm expecting some people to make a lot of money and some people to lose a lot of money. And it is very important that before all the craziness plays out, you have a coherent narrative and have some important thematic points to hopefully immunize yourself against bad narratives, bad information, disingenuous evaluation and analysis of what's going on. And maybe that's us. Maybe at the end of the day you decided that's where we are. But we're going to give our best shot at breaking down some of the narratives at play here and really trying to disintermediate the good guys from the bad guys, the nuance and complexity from the simplistic explanations. That starts with the concept of short sellers. Now, if you're a longtime viewer of the rundown, you'll remember we broke down the Wirecard fraud and the immediate evaporation of $2 billion on their balance sheet and the exposure of a top-tier German company being exposed as a fraud. The folks that were early to that game, before the journalists, before the general market, were short sellers. And part of the narrative here with the people celebrating the fact that Melvin, who was shorting GameStop, has lost 53 of their portfolio value in this GameStop run-up, they're celebrating generally the fall of short sellers, and the notion that any investor would be short is so pessimistic. Right. It's so, celebrating the failure and the fall of others. And it's important to differentiate certain types of short sellers and the exceptionally important role that these characters play in markets generally. Two of the great names in short selling, Jim Chanos and Mark Cohodes, are quintessential examples of great, valuable, value, health, and wealth generating for the general population through their work. Jim Chanos exposed the Enron fraud early in the game. Now, plenty of people still lost their shirts, but had he not done so, had he not given information to journalists, had he not pushed that narrative forward and profited from the fall of Enron, it could have potentially gone on further and picked up more momentum and more buyers and hurt more people. That's how these scams and frauds work. They collect. If Bernie Madoff had been caught 10 years earlier, that's 10 years worth of people defrauded who otherwise wouldn't have been.
Yep.
And so, similarly, Mark Cohodes has exposed deeply unethical biotechnology firms who are putting people's lives at risk with faulty medical devices, faulty medical products, and really gross and disgusting tactics for getting these products used by doctors via his short selling. So that form of short selling is an essential good to our society, and we'd be in deep fucking shit if they weren't doing what they were doing. So you need to be grateful for characters like that. On the flip side, folks like Melvin, to short at all is also not inherently bad. What these types of hedge funds are called long short hedge funds. Basically, what they try to do is they take some equities that they are long, that they are believers will go up, and to hedge the risk of having almost exclusively a view that things are going up. They short some other things that they believe are going down. And the hope is that you're marginally right on both, or at least right enough on one to cover for the losses in the other direction. When you get short squeezed, like Melvin has been associated with GameStop, it doesn't matter what your longs are. You're wrecked just on the basis of your short positions. And the reason for that is the obscene amount of leverage that they've put onto these equities with very, very liquidity to get out of those extremely levered up bets. That is the part that is unhealthy. That is the part where a share is being more than 100% shorted because someone shorts an equity, loans it out to someone else, and they short that equity again, which causes the systemic risk, which causes the undue risk burden on a portfolio that leads to this meltdown. And Melvin, being down 53% is as good as dead, because if you think about this, if you're an institutional investor and you've put your money in Melvin and you see that they're down 53%, what you're doing today, you're doing this weekend, but what you're doing today is saying, get me as much of my money as you can right now, because I'm afraid you're going to go to zero. And I would rather get 47 cents on the dollar back, or 40 cents on the dollar back, or 30 or 20 cents on the dollar back than zero. So what they're going to do, even if they were out of their short position, which they are not, basic game theory, you don't tell everyone, hey, I'm out of my short, if you're not out of your short.
Right.
What is the benefit of saying that otherwise?
Yeah.
So they're getting redemptions, is basically the institutional investor saying, give me some money back. So they're going to have to sell everything, get their money out, and they're gone. That is an important nuance here, and one of the dangerous potential narratives that might float out is that we should ban short selling. That is exactly what Germany did for the 12 months before Wirecard blew up to protect a bad company. Banning short selling is not even worthy of debate. It is a fucking stupid policy proposal, and you should take anyone who says that less seriously than you do now.
Fair enough.
Speaking of that, we want to talk about Robinhood. So Robinhood shut down trading associated with a bunch of meme stocks, and actually extended it out to like 30 different stocks, and has since drawn that down, but is still limiting the amount of buys possible for GameStop. There is the kind of tinfoil conspiracy hat theory analysis of, what did I just say? Tinfoil conspiracy theory analysis of that, which is someone just put their elbow down on them and said, you can't do that anymore. As we've learned more, this is actually much more about the structural integrity of the pipes associated with the risk on the system when there are these enormously volatile moves, and more indicative of the fact that this is still a somewhat outdated, less than modern system. And if there was perhaps a blockchain that had every single share accounted for, and it was perfectly legible to all parties involved exactly where each equity was, you would not have this issue of the undue risk of these shares being lent out more times than they actually could feasibly be.
Right.
So what happened here is the prime broker that Robinhood routes their trades through. Prime brokers are the ones that are actually handling each conversion, each transaction that's occurring. Robinhood is a layer on top of that makes it easy for retail and traders to get in, but those trades are then routed down through the prime broker. Said, yo, you are bringing a bunch of risk onto our system. We need to de-risk that move. And so we are saying that you need to collateralize all these moves in a shorter window of time. The basic example here is, you've got a credit card, you've built your life around saying, okay, I'm going to swipe this credit card, and then every 30 days later, I'm going to have to pay a bill. And that 30-day spread allows me to potentially get my paycheck in, allows me to move funds as I need to, but I know that bill is coming down in time. With these prime brokerages, it's not 30 days, but it's called T+2. The transaction plus 2 days later is when that deal needs to be covered and collateralized. The prime brokers came to Robinhood and said, not anymore. We need same day collateral, which basically means that they need 10x the cash in order to allow these transactions to occur. And so they were simply in a crunch where they didn't have the cash. They raised $1 billion overnight from their existing investors just to keep the lights on. And so the big mistake here was from a PR standpoint, just being utterly transparent from the jump.
Yep.
Hey, we're a startup. We're still trying to figure things out. We're first in the App Store with more traffic to our servers, 2.7 million daily active users. We simply are stretching the limits of what we're capable of. We are not trying to shut you down.
Yeah.
We are not going to pull this move where you can only sell and you can't buy.
Yeah.
That looks shady AF.
For sure.
If you just said, hey, we have to pause all trading for just some period of time while we cover this thing, here's exactly why we have to do it, and we will be back tomorrow, would have been a completely different narrative.
It created such an additional layer of muddiness and just distrust that this whole thing did not need.
Right. But with all this happening, we always think about companies failing because there's not enough going on, they're not doing enough business, they're overinflating the numbers. You can also be killed by too much growth. And the other concern here is if they're taking an additional $1 billion from existing investors, if they have to tap a $500 million line of credit, which they've done with their bank, are they even going to have enough to deal with this if this week plays out as crazy as we expect it to be? And how accurate are their books? Because to come back to the Wirecard example, Ernst & Young, who signed off on an audit of Wirecard, said, yep, all good here, is the same entity that has audited Robinhood and said, all good here. Yep. That is not me insinuating that they're an outright fraud like Wirecard. That is not what we're saying at all. But does knowing that the same auditor that handled Wirecard handled Robinhood give you more or less faith in that platform?
Oh, absolutely less. And that's what's wild to me is no one is talking about that.
Yes.
No one is drawing that connection, and it's frightening that there are people with millions and billions of dollars on the line, and that's totally being ignored.
To move on to another theme here, speaking of millions and billions of dollars, Wall Street Bets, the subreddit where the GameStop trade has been started, initiated, born from, with characters like Roaring Kitty, has grown in 2 weeks from less than 2 million Redditors to more than 7 million. That is a staggeringly large amount of growth. And what has been identified there is a significant improvement in the quality of the analysis going on in some of those posts. Some of them are hilarious memes like this. And some of them are deeply technical analysis breaking down the amount of short positions out on the market and the amount of longs and the implications for future days of trading to come. Now, what sophisticated eyes will tell you is that that does not look like the analysis that was going on in the recent past.
Right.
And so what we can infer from that is that there are now sharks in the water. There are now pros feeding their professional research that you would actually find at a trading desk at one of these large hedge funds to the people, because they want the people, the retail traders, to hop on their side of the trade. They want them to stay in the trade, and it speaks to the fact that this trade with GameStop is not purely, once again, a too simplistic narrative. Retail, revolution, renegades over here, and hedge fund Wall Street over there. That is grossly oversimplistic analysis. If you look at this graph, you can see the largest positions in GameStop as of this weekend before markets open. If you'll train your eye to the 35th largest holder is a company called Millennium. They're a hedge fund with $39 billion in assets under management. They are long on GameStop, looking to take advantage of the short squeeze. They have access, as you would imagine, to grade A research. And if they've paid for it, if it builds this case for long the position as opposed to short, squeezing Melvin, squeezing the other firms that are short the position, then they would do well to allow that research to be spread far and wide by willing participants.
Totally.
So, as if you've hopped into Wall Street Bets, if you've looked at this analysis, you need to be eyes wide open that you are no longer alone with your small community of fellow Redditors, and that the stakes of this are so high, there are big fish floating around. Another part of this is the idea that another thing that's supposed to happen this week is a squeeze on silver, which, similar to the short squeeze with GameStop, if the price goes up, all the people that are short silver will be in deep, deep doo-doo because they have an obligation to deliver silver sometime in the future, and they'll have to pay exact same mechanism. That is something that has been fed by the Wall Street sharks into the group. And you'll see if you go in there's some people being like, yo, this is not our narrative. This is just other people trying to feed us a narrative. Please be careful and do not participate in that. But that's what's going on right now. It has moved up to that sophisticated level of chatter.
Yeah.
In that same vein, folks that are long GameStop, and we talked about this a little bit on Friday, but I just want to make the point again. The illiquidity of these shares, the challenges that anyone with a short position will have getting those shares, and why they're preaching diamond hands that don't sell, that hold tight to those shares, is at number 2, BlackRock, and number 4, Vanguard. And there's other entities here, but these are the kind of 2 bellwether ones. These are index funds. These are unthinking, robotic entities that hold those equities as a index of entire segments of the market, and will be illiquid in their holding of that position until the price starts to fall. They will not sell before that because they just think about it so simply and mechanically in terms of what they're holding. When this all comes through, and some people lose a lot of money and some people make a lot of money, one of the other narratives will be that this individual stock picking is so risky. We need to protect individual investors from themselves and prohibit the excessive purchasing of individual securities. The 2 entities that will be funneling as many dollars as they can, lobbying regulators to that end, pushing the PR narrative that that is the case, is Vanguard and BlackRock. And they are already today spending more on corporate lobbying in the US government than any other financial institution. I'll say that again. The index fund purveyors, BlackRock and Vanguard, spend more lobbying your elected official than any other financial institution, because that is their business model, and that is what they want to see extended. Now, are index funds universally bad? No. Are they universally good? Also, no. We need to see the nuance in this picture, in that the index funds, also, when you have that big a position on GameStop, you have the right to pick board seats evaluating or leading the actual GameStop endeavors. There isn't someone at Vanguard sitting on the board, but they have those board seats that allow those elected officials to occupy the space. Those are not the characters with the most discerning eye for who would be good or bad leadership, who is acting unethically in the operation of the company versus ethically. It is the activist individual sellers who have that more discerning eye because of their more concentrated positions. So there is negative downstream effects to the over-indexation of markets generally, and there's also risks on the opposite, that uninformed people who don't know what they're doing get wrecked in an individual stock like GameStop.
This is so, it's just wacky. It's impossible to follow all of the different threads of this story, and I think I've tried to do that as much as I can over the last week and 2 weeks since it's been unfolding, but I have learned so much about how all of these systems work in the last week. If you would have tried to explain this to me a month ago, I would have been, what are you talking about? But it's just such a wide wake-up call for a lot of people who, they hear about the stock market in very vague and abstract terms, but something like this, a story like this that is so public-facing, so taking over every headline, I think a lot of people are just going to take the extra time and care to educate themselves on just basic economic structures. I know I have, and I, like you who, you have an economics degree, you know a little bit more about this stuff, you have a little bit more insight. I've learned a lot from you. I hope the audience has learned a lot just coming to the rundown, and hope you enjoy the memes as well.
Yes. And one last idea, and then we'll wrap this. I'm sorry we're going so long. The other piece of analysis that immediately flags someone as not particularly critically thinking is, has the fundamental value of AMC or GameStop or any of these meme stocks changed because of the short squeeze? If someone says no to that, they are not thinking critically about the underlying business. When the equity of a stock explodes higher like it has, what AMC can do, what GME can do, what these other equities can do, is they can issue more shares or sell shares that they're holding themselves, turn that into cash, and use that cash to either fuel growth or pay down debt on their existing balance sheet. That is exactly what has happened with AMC. Silver Lake, who we've talked before about being a price maker, giving Airbnb very onerous terms when they needed debt earlier in 2020, they had a debt deal with AMC when they needed money to potentially get out of the pandemic and keep their cinemas open. That had a convertible deal within it where, hey, if price goes above a certain point, we can convert our bonds into equity. They did that. They sold their equity stake in AMC with the pump that happened associated there. And now AMC has less debt on their balance sheet than they ended the year 2020 with, which makes them a healthier company with a greater chance of actually surviving this pandemic with the business still intact.
Which is so crazy that it happened that quickly. That's what blows me away about this entire thing, is you hear about all these companies like preparing to go public and raising rounds of funding that takes so long, and this just it happens so quickly. It unfolded at such a rapid rate and is literally changing lives. It's insane.
Yep. So that's GameStop. There will be more to say here. If you're investing, please be careful. Hopefully construed none of this as financial advice to either buy or sell. But it is something worth paying attention to, because there is a lot here that is a bunch of different disparate forces coming together for one heck of a week.
Definitely.
Two other small stories that we want to run through quickly. First is, over the weekend there was also a military coup in Myanmar. Aung San Suu Kyi, probably said that wrong, the effective central entity of the ruling party in Myanmar, has been taken into custody by military forces who say they'll be running the government for 1 year. Her party claimed 396 of 476 seats in their, I don't know if it's necessarily a parliament, but their governing body. And this is the third coup in Myanmar since the British left in 1948, the first in 1962, the second in 1988. To me, this is indicative of another thing that we've talked about, of general instability across the world as the US recedes from a position of being the world's police and imposing stability on other entities. I think that we're going to see more things like this play out over the coming decade, and I don't want to pretend to know enough about the politics of Myanmar to really make a judgment call one way or another as opposed to who this is good for. But you know that in a situation where internet was cut, power was cut, and there is this amount of turmoil, there are plenty of good, hardworking, well-intentioned people caught in the crossfire, not maybe literally, but more metaphorically, as different parties compete for power. And our thoughts and prayers basically go out to those people involved.
Definitely.
And the last one, another thing that happened over the weekend, was Chinese overnight repo rates hit a 6-year high. And you think about the US economy, you think about the last crash being in 2008, but in China, they have not necessarily followed that same cyclical cycle. And the last time that we saw these super high rates, we saw a relative crash in Chinese equities. And similarly, right before the pandemic, there were repo rate issues here in the United States associated with the exchange of value between large financial institutions and banks. If you don't understand what repo rates are, it is one of the more Byzantine, confusing elements of our financial system. The basics are that, similar to Robinhood needing to settle those transactions after the fact, and you having this grace period or window with which to settle these different transactions, overnight, while the books are getting evened out and people are assessing their risk and preparing themselves for the next day of trading, folks that own securities will lend those securities out for cash, and vice versa, people will lend cash out for securities to help people make their books more even and deleverage and collateralize their different obligations. When repo rates are going up, what that means is that there are people who need cash. They're willing to pay a higher rate for it. So you imagine when you really need money, you'll pay any interest rate. When you don't really need money, you'll shop around for a low interest rate. When repo rates are going up, what that is saying is people need cash. The folks with cash aren't willing to give it at the current interest rate, so a higher rate needs to be proposed. And so that means there are a lot of people looking for cash and not necessarily able to get it. That's happening right now, or happening over the weekend in the Chinese markets. The People's Bank of China injected 98 billion yuan into those markets in order to help them function and bring that rate down. But you don't inject 98 billion when everything's clean and tidy. So another antennas up in a bunch of different arenas for accelerating risk. It's going to be a heck of a week.
Yes, feels monumental. Well, that's a rundown.
Yeah.
Damn. Would you be a short seller in another life?
Probably. I don't know. I think the issue is that a lot of those characters default, I don't want to say to pessimism, but they're very quick.
They're skeptic about everything.
They're very skeptical.
Yeah.
And I'm probably, like, if I'm evaluating myself, I'm probably a little too default optimist as opposed to default pessimist to really be a super effective. Like, I watch a lot of the videos with them, and I can get there. Like, I can be there in certain instances, but my kind of default is optimism. So I don't think that that would be like the idealized version of my personality.
Makes sense. Self-awareness, kids.
Yeah.
Cool.
Oh, missed.
That's a rundown.
Tell people about January.
Yeah, we had a big month for January. If you are familiar with the Piper brand at all and have been following us for some time now, you know that we have a rallying cry every year that we orient all of our goals around. And so this year, our rallying cry was audience first. And that meant that we're putting our focus into building our YouTube audience, building our TikTok audience, and trying to collab more with other creators around the city and beyond. So TikTok, we have seen some massive growth. We started out the year with 12,000 followers, and that was we accrued those on kind of two different flukes from last year. Two different videos went viral, and we just happened to pick up 12,000 followers along the way. This month, however, this past month, we have been posting at least once a day on TikTok, which our goal for the year was create 365 TikToks, which we're going to blow that out of the water. And we ended January with 50,000 followers, and that is just continuing to grow faster and faster. It has been absolutely insane. First of all, the notifications thing is wild. Like, you can just look at your phone for 20 minutes and notifications do not stop. I have done that. People really like lists, we found, so we're going to continue sharing our opinions on TikTok, taking the heat from the haters and the love from the loyal followers, and we will keep you updated as to how that is going. Audience first. Speaking of which, if you've watched this long, we really appreciate you. Hit like and subscribe and ring the notification bell so you get notified whenever we post a new video.